Today we are going to talk about these topics. Number 1, paying your bills on time. Number 2, savings bond makes life simpler. Number 3, a new Wall Street line dance performance. Number 4, energy conservation begins at home. Number 1, how many monthly bills do you get? You may have a mortgage bill, a car payment, heating, electricity, gas, telephone, television, and that doesn't even begin with your credit cards and store card payments. The fact of the matter is that people today have more monthly commitments than ever before. And with all these various bills, it is very easy to forget to pay one on time. Then there is a wholly separate issue of whether or not you can afford all your bills. Sometimes we may simply have overextended ourselves financially, and in such situations we may not be able to pay all of our bills as they fall due. And what if you were to lose your job, or become ill or otherwise unable to work? Even if this is only for a short time, you will have some very real problems meeting all your monthly bills. Penalties. This can be disastrous. First of all, most creditors will slap late payment penalties and other administrative charges to your account if you are late. Some may recall or try to repossess assets if they have security over them. This is most serious in the case of your house, but can also apply to your car or any other purchase you have made by installment, such as a television or computer. How can you provide for such an outcome? Well, having some savings is a very good start. This should be able to cushion you for a few months should you lose your job. Then there is the fact that it is perhaps not so wise to rack up so many commitments that you can't reduce your outgoings at short notice. Insurance protection. Another option to consider is payment protection insurance. This can be very helpful and is designed specifically for situations such as these. How it works is you pay an amount extra on top of your monthly bill. This is automatically added to your bill and depends on how much you have outstanding for each bill. For example, payment protection insurance on a credit card might be priced at. Number 2, the modern socio-economic scenario has made life really very complicated for us, as we all have to run after money to make ends meet. In this age of rapid commercialization of economy, we are always running short of cash no matter how much we earn. As the economy scales new highs, aggressive consumers are always busy exploring new ways and means to augment their income. For spendthrift people, it may, however, turn out to be an arduous task to save money. Therefore, it makes sense to invest in saving bonds so that you never reach a stage of bankruptcy and always have some cash to fall back upon in times of need. Industry experts strongly recommend consumers to use saving bonds as a reliable means of letting your money grow at an amazingly fast pace. According to a recent media report, savings bonds currently bring greater benefits than many savings or money market accounts. With savings bond, you can solve all your monetary woes. Savings bond takes care of your child's higher education or even your post-retirement ordeal. Some of the advantages of investing in saving bonds are as follows. Monthly interest rates on savings bonds accumulate on a monthly basis. Savings bonds offer enviable rates of return in comparison to other bonds. Savings bonds come with a particular registration number so that they can easily be replaced in case it is stolen or tampered. You do not have to dig deep into your pocket to buy a savings bond. You have to shell out as little as $25 to get a savings bond. Another unique feature of saving bond is that they are easily exchangeable. You can get cash out of your bond easily in case of an emergency. One of the greatest benefits acquired from investing in savings bonds is tax exemption. The interest amassed on savings bonds is free from all state and local income taxes. Last but not the least, savings bonds act as a great balancing factor to your existing investment folder, paving a way to start building your own capital. This unique feature of the savings bond gives you enough room for diversification of funds. There are a variety of savings bonds on offer. You just have to do a little bit of market research to find out which one suits your bill perfectly. Riding on its highly beneficial factor, savings bonds have really emerged as a preferred investment option everywhere. Series E or Series I bonds are the safest bet amongst all categories of savings bonds. Savings bonds have undoubtedly emerged as the best add-on to your investment portfolio. Therefore, if you want to make your life simpler with little financial worries, then investing on savings bond is a must. Your post-retirement life or child's higher education expenses may not seem to be at all difficult after investing on savings bonds. So, get ready to outsmart your peers by investing on savings bonds, and it will save you from unnecessary harassments and gift you a secured, peaceful life in return. Number 3. It matters not what lines, numbers, indices, or gurus you worship, you just can't know where the stock market is going or when it will change direction. Too much investor time and analytical effort is wasted trying to predict course corrections. Even more is squandered comparing portfolio market values with a handful of unrelated indices and averages. If we reconcile in our minds that we can't predict the future, we can move through the uncertainty more productively. Let's simplify portfolio performance evaluation by using information that we don't have to speculate about, and which is related to our own personal investment programs. Every December, with visions of sugar plums dancing in their heads, investors begin to scrutinize their performance, formulate coldas and shouldas, and determine what to try next year. It's an annual, masochistic, rite of passage. My year-end vision is different. I see a bunch of Wall Street fat cats, rope and loll, while investors determine what to change, sell, buy, reallocate, or adjust to make the next 12 months behave better financially than the last. What happened to that old-fashioned emphasis on long-term progress towards specific goals? The use of issue breadth and 52-week high-low statistics for navigation, and cyclical analysis and economic realities as performance expectation barometers makes a lot more personal sense. And when did it become vogue to think of investment portfolios as sprinters in a 12-month race with a nebulous array of indices and averages? Why are the masters of the universe rolling on the floor in laughter? They can visualize your annual performance agitation ritual producing fee-generating transactions in all conceivable directions. An unhappy investor is Wall Street's best friend, and by emphasizing short-term results and creating a super burlesque environment, they guarantee that the vast majority of investors will be unhappy about something, all of the time. Your portfolio should be as unique as you are, and I contend that a portfolio of individual securities rather than a shopping cart full of one-size-fits-all consumer products is much easier to understand and to manage. You just need to focus on two longer-range objectives: growing productive working capital, and increasing base income. Neither objective is directly related to the market averages, interest rate movements, or the calendar year. Thus, they protect investors from short-term, anxiety-causing events or trends while facilitating objective-based performance analysis that is less frantic, less competitive, and more constructive than conventional methods. Briefly, working capital is the total cost basis of the securities and cash in the portfolio, and base income is the dividends and interest the portfolio produces. Deposits and withdrawals, capital gains and losses, each directly impact the working capital number, and indirectly affect base income growth. Securities become non-productive when they fall below investment grade quality and or no longer produce income. Good sense management can minimize these unpleasant experiences. Let's develop an all-you-need-to-know chart that will help you manage your way to investment success in a low failure rate, an emotional environment. The chart will have 4 data lines, and your portfolio management objective will be to keep 3 of them moving upward through time. Note that a separate record of deposits and withdrawals should be maintained. If you are paying fees or commissions separately from your transactions, consider them withdrawals of working capital. If you don't have specific selection criteria and profit-taking guidelines, develop them. Line 1 is labeled working capital, and an average annual growth rate between 5% and 12% would be a reasonable target, depending on asset allocation. An average cannot be determined until after the end of the second year, and a longer period is recommended to allow for compounding. This upward-only line is increased by dividends, interest, deposits, and realized capital gains and decreased by withdrawals and realized capital losses. A new look at some widely accepted year-end behaviors might be helpful at this point. Offsetting capital gains with losses on good quality companies becomes suspect because it always results in a larger deduction from working capital than the tax payment itself. Similarly, avoiding securities that pay dividends is at about the same level of absurdity as marching into your boss's office and demanding a pay cut. There are 2 basic truths at the bottom of this: you just can't make too much money, and there's no such thing as a bad profit. Don't pay anyone who recommends loss taking on high-quality securities. Tell them that you are helping to reduce their tax burden. Line 2 reflects base income, and it too will always move upward if you are managing your asset allocation properly. The only exception would be a 100% equity allocation, where the emphasis is on a more variable source of base income. the dividends on a constantly changing stock portfolio. Line 3 reflects historical trading results and is labeled net realized capital gains. This total is most important during the early years of portfolio building, and it will directly reflect both the security selection criteria you use and the profit-taking rules you employ. If you build a portfolio of investment-grade securities and apply a 5% diversification rule, you will rarely have a downturn in this monitor of both your selection criteria and your profit-taking discipline. Any profit is always better than any loss, and, unless your selection criteria is really too conservative, there will always be something out there worth buying with the proceeds. 8% singles will produce a larger number than 25% home run, and which is easier to obtain? Obviously, the growth in line 3 should accelerate in rising markets. The base income just keeps growing because asset allocation is also based on the cost basis of each security class. Note that an unrealized gain or loss is as meaningless as the quarter-to-quarter movement of a market index. This is a decision model, and good decisions should produce net realized income. One other important detail: no matter how conservative your selection criteria, a security or two is bound to become a loser. Don't judge this by Wall Street popularity indicators, tea leaves, or analyst opinions. Let the fundamentals set up the red flags. Market value just can't be trusted for a bite-the-bullet decision. But it can help. This brings us to line 4, a reflection of the change in total portfolio market value over the course of time. This line will follow an erratic path, constantly staying below working capital. If you observe the chart after a market cycle or two, you will see that lines 1 through 3 move steadily upward regardless of what line 4 is doing. But you will also notice that the lows of line 4 begin to occur above earlier highs. It's a nice feeling since market value movements are not, themselves, controllable. Line 4 will rarely be above line 1, but when it begins to close the gap, a greater movement upward in line 3 should be expected. In 100% income portfolios, it is possible for market value to exceed working capital by a slight margin, but it is more likely that you have allowed some greed into the portfolio and that profit-taking opportunities are being ignored. Don't ever let this happen. Studies show rather clearly that the vast majority of unrealized gains are brought to the Schedule D as realized losses. And this includes potential profits on income securities. And, when your portfolio hits a new high watermark, look around for a security that has fallen from grace with the S&P rating system and bite that bullet. What's different about this approach, and why isn't it more high-tech? There is no mention of an index, an average, or a comparison with anything at all, and that's the way it should be. This method of looking at things will get you where you want to be without the hype that Wall Street uses to create unproductive transactions, foolish speculations, and incurable dissatisfaction. It provides a valid use for portfolio market value, but far from the judgmental nature Wall Street would like. Its use in this model, as both an expectation clarifier and an action indicator for the portfolio manager, on a personal level, should illuminate your light bulb. Most investors will focus on line 4 out of habit, or because they have been brainwashed by Wall Street into thinking that a lower market value is always bad and a higher one always good. You need to get outside of the market value versus anything box if you hope to achieve your goals. Cycles rarely fit the January to December mold, and are only visible in rear-view mirrors anyway. But their impact on your new line dance is totally your tune to name. The market value line is a valuable tool. If it rises above working capital, you are missing profit opportunities. If it falls, start looking for buying opportunities. If base income falls, so has the quality of your holdings, or you have changed your asset allocation for some reason, etc. So Virginia, it really is okay if your market value falls in a weak stock market or in the face of higher interest rates. The important thing is to understand why it happened. If it's a surprise, then you don't really understand what is in your portfolio. You will also have to find a better way to gauge what is going on in the market. Neither the CNBC talking heads nor the popular averages are the answer. The best method of all is to track market stats, that is breadth statistics, new highs and new lows. If you need a drug, this is a better one than the ones you've grown up with. Number 4. As Americans face rising fuel prices, many are looking for ways to save money and energy in their homes. The pressure to reduce energy consumption and costs is inspiring homeowners to challenge the relevance of old heating and hot water solutions and consider other cost-effective options, such as wall-hung boiler technology. Wall-hung boilers have been common in homes throughout Europe for the past 3 decades and are now emerging as a popular alternative for heating homes and businesses in North America. Baxi Luna wall-hung boilers, for instance, are helping homeowners throughout the U.S. cut their home heating and hot water fuel consumption in half. These boilers are fully modulating, meaning they start at a preset, high fire position and gradually reduce fuel output until the heating demand is met. At this point, the boiler automatically shuts off. Billed as one of the quietest boilers on the market, Baxi Luna boilers are fired by propane or natural gas. No bigger than a kitchen cabinet, a Baxi Luna boiler can be installed in the closet, saving valuable living space in homes of up to 6,000 square feet. The boiler also is making commercial buildings more efficient. For example, this year a heating specialist in Bedford, Maine, installed 8 Baxi Luna high-efficiency condensing boilers in the City Hall and City Theater. People living in the city expect the new heating system to reduce fuel use by at least 50% and save taxpayers money even in the face of rising fuel costs. Baxi Luna wall-hung boilers are approved by the American Gas Association and Canadian Standards Association. Consumers can take comfort from the boiler's Energy Star certification and H-stamp rating. These environmentally friendly products are quiet enough to install in the back of a large closet, even in the master bedroom. They are ideal for in-floor radiant heating systems and are compatible with any type of air handler, wall or baseboard radiators and custom radiant applications, such as heated towel racks or snowmelt.